All right, let's look at these problems with bonds. It says a bond has a $10,000 face value. Again, that's the amount that you are loaning the company. So that's the P amount. A 3% coupon. Again, the coupon is your interest rate written as a decimal. And a 5-year maturity. So we need to be really, really careful here. It says calculate the total of the interest payments. If it's the total of the interest payments, then they do want T equals 5. Reread these questions very, very carefully because it might say, what is the annual? And if it's annual, you would have had to use T equals 1. So just be very careful when you do these problems on WebAssign. So we're going to use the I equals PRT formula. Here we have I equals P is the $10,000 times the R, which is the 0.03, times T, which it is the total, so it's all 5 years. Plug that into your calculator. Let's see what you're getting. I'm getting a total interest of $1,500. So again, at the end of this 5-year period, they would have to give me the $10,000 that they borrowed back plus the $1,500 in interest. Let's read example 8. Example 8 says a bond has $15,000 face value. Again, that face value is the original investment, the P, the principal. A 4-year maturity. I don't know if T is 4 yet or T is 1. I have to read. And a 3.5% coupon, so that's R equals 0.035. Says what is the total? This one does say total, so again, they're going to want T equals 4. Again, be careful. If it said what is the annual interest payment, you would have used T equals 1. So this is I equals PRT. In this case, P was $15,000. R was 0.035. And T, because it was the total time, is all 4 years. Plug that into your calculator. Let's see what you get. I'm getting a total of $2,100 in interest. So that's how much money you made in interest on that investment. Again, at the end of those 4 years, they would have to pay you the $15,000 back plus the $2,100. All right, so now that we know that stocks are actually purchasing ownership in the company versus bonds, which are loaning the company money, let's go to the third type, which I think is the safest. Well, not the safest. This is where I invest my money. Is something called a mutual fund. So stocks are usually high reward but high risk. You invest in one company. If that company does well, you can bank. If that company does poorly, you can lose every dollar in your account. Okay? Bonds are a much, much safer investment. The safest investment there is. It's a guaranteed backed simple interest loan where they will pay you back and you already know what your interest is going to be before you even finalize the issuance of the bond. Okay? So bonds are very low risk, but the disadvantage of a bond is it's a very low reward. So it's a lower interest rate. So again, stocks high risk, high reward, bonds low risk, low reward. So where's the nice middle ground? And I would say that's mutual funds. So an investment trust is a company whose assets are stocks and bonds. The company do not manufacture a product, but instead purchase stocks and bonds with the hope that their value will increase. A mutual fund is an example of an investment trust. So what does a mutual fund do? A mutual fund says, well, let's say you like, I don't know, how about we looked at Apple earlier, so let's stick with that. So if you want to buy a stock, you could buy just Apple stock. But what if you liked tech giants? So what if you wanted to buy Apple, HP, Amazon, all of that? What if you liked the tech industry? So instead, what you could do is buy a mutual fund, and a mutual fund, rather than you investing $1,000 yourself, takes 100 people, and each of those people invest $1,000. Then they take that $100,000 and they invest it in a variety of stocks and bonds. So what's the advantage of a mutual fund? When you buy, quote unquote, a share of a mutual fund, which is not really a share, but we'll talk about that in a second. But when you buy into a mutual fund, you're not buying the stock of one business, you're buying the stocks and bonds from several businesses. So if one individual business does good or bad, it doesn't affect you as directly as if you buy a stock. It's more of a cushion. So what's good about that is you usually get higher interest rates or higher returns than you would if you did bonds. What's bad about it is you don't necessarily get as high of returns if you would have had stocks. But what's the advantage of mutual funds is it's much lower risk than buying a stock, an individual stock. So mutual funds is moderate risk, moderate rewards. I have all of my personal retirement funds in mutual funds. Okay? So it says when an investor purchases a share in a mutual fund, they're adding their money to the pool along with many other investors. The investments within the mutual fund are called the fund's portfolio. So what do they do with that big pot of cash? They go out and they have a portfolio and they invest in several different companies. The investors in a mutual fund share the fund's profit or losses from the portfolio. Again, it's not an individual stock, it's the combination of all stocks and bonds. So it says an advantage of owning shares in mutual funds is that your money is managed by full-time professionals whose job it is to research and evaluate stocks. You own stocks without having to choose which individual stocks to buy or decide when to sell them. Another advantage is that owning the shares in the fund, you have purchased shares of a stock in many different companies. This diversification helps to reduce some of the risk of investing. So it says, because mutual fund owns many different stocks, each share of the fund represents a fractional interest in each stock. So each day, the value of the share of the fund is called the net asset value, the NAV. Essentially, this would be your price per share, but because it's not the share of an individual stock, we call it the net asset value. So this is your price per share of the mutual fund. That's what a net asset value is. So, how do we calculate NAVs and what can we do? That'll be in the next page.